Every crash writes the same story, just with different names on the front page. In 1929, it was Joseph Kennedy, the shrewd speculator who stepped away from the roaring market months before it collapsed, then made a fortune shorting it on the way down. In 2008, it was Michael Burry and John Paulson, betting against subprime mortgages while everyone else believed housing could never fall. Now, nearly a century after Kennedy and barely 2 decades after Burry, the same kind of investors, the quiet billionaires who understand the rhythm of panic, are positioning once again. They don't time crashes by luck. They read the signals: insider selling, margin debt, yield curve inversions, valuation ratios, and the tone of the crowd. When the noise reaches euphoria, they exit quietly. When fear returns, they reappear, buying when everyone else is broken. It's not mysticism, it's math, psychology, and preparation. Today, as markets sit at record highs and corporate insiders dump billions in shares, the pattern that appeared in 1929 and 2008 is unfolding again. Warren Buffett sits on more cash than at any point in history. Jeff Bezos and Mark Zuckerberg are unloading stock. Hedge funds are buying volatility insurance that only pays when markets collapse. The cycle is repeating. The same playbook, the same patience, the same profit waiting at the bottom. The only question left is whether you recognize the pattern before it reaches its final stage. Every great fortune born from a crash begins with silence. In the first stage, the smart money leaves the party while the music is still playing. They don't predict the exact date of the collapse. They simply recognize when risk outweighs reward. In 1929, Joseph Kennedy didn't have a crystal ball. He had common sense sharpened by experience. By the summer of that year, margin debt had soared to record levels, with investors borrowing up to 90% of stock value just to buy more. Kennedy understood what that meant. One small decline could trigger forced selling across the system. So he sold. By the time the Dow Jones peaked on September 3, 1929, Kennedy was almost entirely in cash. When the crash came 7 weeks later, he was ready to short the market while others were ruined. The same pattern reemerged in 2005 to 2007. Michael Burry and John Paulson didn't know exactly when the housing bubble would burst, but they knew it couldn't last. They examined loan level data, saw adjustable rate mortgages given to unqualified borrowers, and realized the math was fatal. While ordinary investors poured into real estate, they exited, shifting into credit default swaps that would pay out when the system collapsed. For nearly 2 years, they endured ridicule and redemptions, but when the crash arrived, their patience became profit. And now, in 2025, the same quiet exits are underway. Warren Buffett has amassed $325 billion in cash. Jeff Bezos has sold over $13 billion in Amazon shares. Mark Zuckerberg has dumped billions in Meta stock. Insider selling across corporate America is at its highest level since 2007. Stage 1 is repeating. The calm before the storm, when the smartest investors step aside while everyone else still believes the rally will never end. After exiting while optimism still reigns, the next move for the smart money is not retreat, it's preparation. This is stage 2, when billionaires quietly start buying insurance on the system itself. In 1929, the equivalent of insurance was shorting stocks, borrowing shares and selling them high, knowing panic would let them buy them back for pennies later. Joseph Kennedy did exactly that through the summer of 1929, paying borrowing costs month after month as the market kept climbing. His peers mocked him, but when Black Thursday arrived on October 24th, his patience turned into one of the greatest fortunes of the era. In 2008, the playbook evolved. Michael Burry and John Paulson couldn't short mortgage bonds directly, so they created the tool that could: credit default swaps. These swaps worked like fire insurance for debt. If the mortgages defaulted, the swaps paid out in full. Between 2005 and 2007, Burry spent millions in premiums as his investors grew restless, calling him crazy for betting against America. Yet when subprime defaults exploded and Lehman Brothers collapsed, those swaps returned hundreds of times their cost. Paulson's fund made $15 billion from the same bet. Now, in 2025, the modern version of this stage is unfolding again. Hedge funds are loading up on put options, VIX calls, and credit default swaps on commercial mortgage-backed securities. The put-to-call ratio, the market's fear gauge, has stayed abnormally high, signaling institutions are protecting against a sharp fall. The cost of insuring against commercial real estate defaults has jumped 400% since 2021. Once again, the elite are quietly paying premiums while retail traders celebrate new highs. Insurance is cheap before the storm, and priceless after it hits. Stage 3 is where patience turns into precision. This is the moment when the smart money stops simply protecting itself and starts hunting. Every major collapse begins with weak points hidden beneath the surface, and those who spot them early position to profit the most. In 1929, Joseph Kennedy didn't short the entire market blindly. He targeted the companies most bloated with margin debt and speculative buying. When prices fell just 10%, those firms were forced to liquidate first, triggering a domino effect that cascaded through the system. By shorting the over-leveraged, Kennedy multiplied his returns while others lost everything. Fast forward to 2007, and the pattern was identical. John Paulson and Michael Burry didn't bet against all real estate. They focused on the worst tranches of subprime mortgage bonds. Burry analyzed loan-level data, identifying mortgages in states like Florida, California, and Nevada, where prices had risen 200% in just a few years. When borrowers began to default, those specific bonds imploded. Paulson took it further, shorting financial firms like Lehman Brothers and Washington Mutual, which were drowning in those same toxic assets. When those institutions collapsed, their bets paid billions. Now, in 2025, the next targets are clear: commercial real estate and regional banks. Office towers sit 40,050% vacant across major U.S. cities, financed at 3% interest rates that must now be refinanced at 8%. Over $2 trillion in commercial mortgages come due by 2026, and many cannot roll over. Meanwhile, regional banks, the primary lenders for these properties, face the same trap. Their loan books are filled with debt that will soon go bad. Hedge funds are already shorting these sectors, positioning for defaults that could trigger the next wave of panic. Stage 3 is in motion. Every crash ends the same way, not with chaos, but with silence. The panic burns itself out, and what's left is a marketplace stripped of confidence and liquidity. That's when Stage 4 begins, the fire sale. This is where the billionaires who exited early and insured wisely re-emerge, not to panic sell, but to buy. In 1932, 3 years after the Dow Jones began its collapse, the market had fallen 89% from its peak. Companies with solid balance sheets were trading below the cash they held. Joseph Kennedy, now flush with cash from his short positions, began buying stocks, real estate, and entire businesses at pennies on the dollar. He purchased foreclosed properties, struggling companies, and assets no one else wanted, the raw material for generational wealth. By the mid-1930s, Kennedy had multiplied his fortune and laid the financial foundation for one of America's most powerful political dynasties. The same cycle repeated in 2009. At the height of fear, when Lehman Brothers was gone and headlines screamed depression, Warren Buffett stepped in. He invested $5 billion in Goldman Sachs and another $5 billion in Bank of America, securing 10% annual dividends and warrants to buy common stock at bargain prices. It was a masterclass in Stage 4 timing. When everyone else hoarded cash, Buffett deployed it. Within years, those deals alone earned tens of billions in profit. Now, in 2025, the fire sale hasn't begun, but the cash is ready. Buffett's $325 billion war chest, private equity dry powder, and family office reserves are all waiting for the same trigger: panic. When valuations collapse, when the fear peaks, and when the headlines scream "end of capitalism," that's when the same investors who left early will quietly buy everything back at half the price. To most people, a crash feels like the end. To billionaires, it's simply stage rotation, another turn of a clock that never stops. They don't see markets through emotion, they see mechanics, patterns, and psychology. In every major collapse, the public and the elite play opposite roles. The public believes wealth is built by holding through the storm. The elite know wealth is built by exiting before it. Joseph Kennedy once said, "Only a fool holds when the world is burning." He understood that markets don't fall because of panic. Panic happens because markets were already unstable. That same logic guided Michael Burry in 2005 when he faced relentless pressure from investors demanding redemptions. They thought he was wrong. He knew the data was right. His spreadsheet showed default probabilities, not emotions. Every month his trades lost money, but his conviction was mathematical. In 2008, John Paulson followed the same discipline. While media pundits debated optimism, he quietly hired analysts to comb through mortgage databases and identify the weakest securities. His move wasn't risky, it was statistical inevitability. The market was mathematically insolvent. All he had to do was wait for reality to catch up. In 2025, that mindset lives on in the hands of Buffett, Bezos, and the hedge funds tracking every anomaly in credit spreads and liquidity flows. They don't watch headlines, they watch ratios, debt maturities, and insider behavior. While social media celebrates new highs, they're studying volatility decay, cash positions, and yield inversions. Crashes aren't surprises to them, they're scheduled events. The only difference between panic and opportunity is whether you prepared for it. And those who read the pattern understand. Every unprecedented crisis is just the same playbook replayed under a new name. Every major collapse begins with the same quiet signals, invisible to the crowd but crystal clear to those who have seen the movie before. The first and loudest is insider selling. In 2024, corporate executives across America sold more than $160 billion worth of stock, the highest insider liquidation since 2007, right before the housing crash. Jeff Bezos unloaded over $13 billion in Amazon shares. Mark Zuckerberg sold billions in Meta stock despite record valuations. Even Jamie Dimon, CEO of JP Morgan Chase, sold shares for the first time in his entire tenure. These aren't random sales, they're strategic exits. When those closest to the numbers start cashing out, it's not because they need liquidity, it's because they see what's coming. The second signal is cash hoarding. Warren Buffett's Berkshire Hathaway now sits on $325 billion in cash, the largest reserve in market history. Buffett isn't hoarding out of fear, he's waiting for the opportunity that only a crash can create. As he once said, "Be fearful when others are greedy, and greedy when others are fearful." Greed is everywhere right now. Record highs, retail investors buying dips, AI stocks trading at price-to-earnings ratios above 100. Fear has disappeared from the market, which is exactly when the disciplined few prepare to strike. The third signal is valuation distortion. The Buffett indicator, total U.S. market cap divided by GDP, sits near 185%, far above the 120% threshold Buffett himself calls dangerous. Add to that the inverted yield curve, a signal that has predicted every U.S. recession since 1950, and the pattern couldn't be clearer. Every metric is flashing red. The exits are crowded, but the public still thinks the party will never end. For the billionaires, stage one is complete. The chairs are already pulled back before the music stops. Once the quiet exits are complete, the billionaires move to stage two, buying protection while everyone else still feels invincible. In 1929, that protection meant shorting over-leveraged companies. In 2008, it meant buying credit default swaps on mortgage bonds. But in 2025, the insurance game has evolved into something far more sophisticated and more secretive. Hedge funds, family offices, and private billionaires are quietly spending hundreds of millions on what are essentially modern disaster bets. They're buying put options on major indexes like the S&P 500 and NASDAQ, VIX calls that explode in value when volatility spikes, and credit default swaps tied to commercial mortgages and regional bank debt. The numbers tell the story. The put-to-call ratio, a measure of how many investors are betting on decline versus growth, has stayed well above 1.0 for over a year, signaling heavy institutional hedging. The VIX options market, usually quiet in stable times, has seen unprecedented activity, with expiration dates set squarely in late 2025, a window eerily similar to the pre-crash buildup of 2007. Even more revealing, the cost of insuring commercial mortgage-backed securities, CMBS, has jumped over 400% since 2021. Someone is paying enormous premiums to protect against a collapse that most people don't even believe will happen. This isn't speculation, it's preparation. Bill Ackman, the billionaire behind Pershing Square Capital, publicly confirmed that he has renewed his hedge positions against corporate debt, echoing the same play that made him billions in 2020. Others, like Ray Dalio and Stan Druckenmiller, have hinted that they're doing the same. When volatility finally returns, these insurance bets will explode in value. The public will call it luck. The billionaires will call it stage 2 paying off. Again, stage 3 is the strike phase. When the billionaires stop hedging and start hunting, every bubble hides its weakest links, and in 2025, they're easier to spot than most realize. The first and most fragile target is commercial real estate. Across San Francisco, New York, Chicago, and Los Angeles, office vacancy rates hover between 40% and 50%. The work-from-home revolution didn't just change habits, it obliterated the financial model that kept office towers solvent. Properties that once generated steady rental income can no longer service debt issued at 3% interest when refinancing now costs 8% or more. Over $2 trillion in commercial mortgages will mature by 2026, and much of it cannot be rolled over. That math is fatal, and the smart money knows it. Hedge funds are quietly shorting commercial mortgage-backed securities, CMBS, the same instruments that fueled the 2008 crisis, except this time, the collateral isn't suburban houses, it's empty skyscrapers. The price of CDS protection on these securities has skyrocketed, mirroring the spike seen in 2007 before the subprime implosion. Alongside that, regional banks have become the second target. These banks, unlike Wall Street giants, hold a massive share of commercial real estate loans, sometimes 30–40% of their portfolios. When those loans default, capital ratios collapse, triggering forced closures. The preview already happened. Silicon Valley Bank, Signature Bank, and First Republic all failed between 2023 and 2024, before any official recession began. The billionaires have learned from history. They aren't shorting everything. They're aiming at specific, overexposed institutions the same way John Paulson aimed at Lehman Brothers in 2008. When defaults accelerate and banks start falling in clusters, these precision bets will detonate in profit. The collapse of others becomes the payday for those who saw it coming. When fear reaches its peak and the headlines scream collapse, stage 4 begins, the most profitable and ruthless part of the cycle. This is when those who've waited patiently through euphoria and panic begin deploying their war chests. The public sees chaos, the billionaires see discounts. It's the same script played in 1932, 2009, and soon, 2026. After the Dow Jones had fallen nearly 90% in the Great Depression, Joseph Kennedy used his profits from shorting to buy entire companies and prime real estate at cents on the dollar. In the aftermath, while most investors were ruined, Kennedy's fortune multiplied, and the wealth he built funded generations of political power. Fast forward to 2008–2009, the stage 4 masterpiece of Warren Buffett. While panic gripped Wall Street, he invested $5 billion into Goldman Sachs at a 10% dividend, plus warrants to buy stock at a bargain. He repeated the move with Bank of America, earning billions when confidence returned. He wasn't gambling, he was buying inevitability. He knew markets would recover long before fear subsided. Now, the same blueprint is quietly being prepared. Buffett's $325 billion in cash, Blackstone's $200 billion in dry powder, and billions more from private equity giants like Apollo and KKR are waiting for one condition: maximum fear. When commercial real estate defaults cascade, when banks fail, when stocks fall 50% and retail investors panic, these firms will start buying. They'll purchase office towers at 30 cents on the dollar, entire companies desperate for liquidity, and quality stocks trading at their lowest valuations in decades. The moment everyone else gives up is when they step in. That's how billionaires turn crashes into jackpots, not by avoiding the storm, but by owning what's left after it passes. Every crash is less about numbers and more about psychology. The same emotional traps that destroyed investors in 1929 and 2008 are already resurfacing in 2025. Most people believe they'll be rational when the market turns, but they never are. In euphoria, they convince themselves the rally will never end. In panic, they convince themselves recovery is impossible. The billionaires know this pattern intimately. They count on it. When the Dow or S&P 500 are soaring, retail investors chase momentum. They buy the top, believing they're investing in the future. When prices collapse, they freeze, terrified to buy what's suddenly affordable. This emotional inversion, fear at the bottom, greed at the top, is what separates wealth creation from wealth destruction. Joseph Kennedy described it perfectly after 1929. "I sold when everyone else was buying and bought when everyone else was selling." Michael Burry, in 2008, endured years of ridicule while shorting the housing market because he trusted data, not emotion. Warren Buffett's famous line, "Be fearful when others are greedy and greedy when others are fearful," isn't philosophy. It's the operating manual for every billionaire who has survived multiple crashes. The challenge is that recognizing the cycle isn't enough. You must act against your instincts. In stage 1, it feels wrong to sell while everyone else is celebrating record highs. In stage 4, it feels insane to buy while the world looks like it's ending. That's why almost no one follows the pattern. Not because it's a secret, but because it requires emotional discipline bordering on unnatural. Billionaires train for this moment. They wait in silence, watch panic set in, and move only when others can't. The market rewards calm endurance, not excitement, and history punishes everyone who forgets that. If you know what to look for, 2025 is flashing the same warning lights that preceded 1929 and 2008, and the billionaires are reading them in real time. The first signal is the Buffett indicator, which measures total market capitalization against GDP. Historically, anything above 120% signals overvaluation. Today, it stands at 185%, meaning the market is priced for perfection. Buffett himself has said that such levels precede inevitable correction. Yet, rather than buying, he's hoarding more than $325 billion in cash. A silent vote of no confidence. The second signal is insider selling. In 2024 and early 2025, corporate executives sold over $130 billion in company stock, the highest level since 2007. Jeff Bezos sold more than $13 billion in Amazon shares. Mark Zuckerberg liquidated portions of Meta at record highs. Even Jamie Dimon, CEO of JP Morgan Chase, sold stock for the first time in his entire career. These aren't random transactions. They're calculated retreats by people with access to the data the public won't see for another quarter. The third signal lies in credit markets. The cost of insuring corporate and commercial mortgage debt has surged by more than 400% since 2021. That means institutional investors are betting heavily on defaults. Meanwhile, the yield curve, the gap between short-term and long-term treasury rates, remains inverted, a pattern that has preceded every U.S. recession since 1950. Together, these signals form the same map followed in every major downturn: euphoric valuations, insider liquidation, rising credit stress, and denial at the top. The average investor sees strength. The billionaires see fragility. They're not predicting disaster, they're positioning for it. The data doesn't lie, and neither do their trades. Every crash in history ends the same way, not with ruin, but with rebirth for those who prepared. The billionaires understand this better than anyone. Stage 4 isn't just a recovery phase, it's a once-in-a-generation opportunity to build empires from the ashes. After 1929, when ordinary Americans were selling everything to survive, Joseph Kennedy used his cash reserves to buy distressed railroads, banks, and real estate for pennies on the dollar. Within 5 years, he had multiplied his wealth tenfold. That capital later built the foundation of one of the most powerful families in U.S. politics. The same pattern repeated in 2009. Warren Buffett and private equity giants like Blackstone and Apollo Global Management bought assets no one else wanted, shares of banks, insurance firms, and energy companies that had been written off as dead. Within a decade, those investments became worth hundreds of billions. The difference between surviving and dominating wasn't luck, it was liquidity and patience. In 2026, the playbook will unfold again. Buffett's $325 billion, Blackstone's $200 billion, and the dry powder held by dozens of hedge funds are not sitting idle. They're waiting for capitulation. When markets drop 55 to 60%, when bankruptcies spike, when despair peaks, they'll start buying office towers, tech firms, even entire banks. By 2030, those acquisitions will look visionary, not opportunistic. That's why the wealthy don't fear crashes. They depend on them. The real profit doesn't come from predicting booms, it comes from owning the recovery. And while the public will once again be told to stay calm or think long-term, the billionaires will already be executing Stage 4, turning panic into power and writing the next chapter of financial dominance that everyone else will call inevitable after it's too late. The pattern isn't magic. It's math, history, and psychology repeating in perfect sync. From Joseph Kennedy in 1929 to Michael Burry in 2008 and Warren Buffett today, the same 4 stages have defined how the world's richest investors survive every collapse and emerge stronger than before. Stage 1, exit early while the crowd is still celebrating. Stage 2, buy insurance when everyone thinks it's unnecessary. Stage 3, target weakness, shorting the sectors already cracking beneath the surface. And Stage 4, buy the panic, turning chaos into opportunity. It's not luck, it's discipline, data, and patience. The 3 currencies that matter more than cash when the world starts to burn. Right now, in late 2025, we are deep in Stage 3. The signals are there. Record insider selling, surging credit costs, overvalued markets, and institutions quietly positioning for the fall. The crash hasn't arrived yet, but the foundation has already cracked. When the panic finally hits, the same playbook will unfold. Most people will sell everything in fear. A few will be waiting, calm, liquid, and ready, because that's what separates billionaires from everyone else. They don't predict the future, they prepare for it. The wealth of tomorrow is being positioned today, quietly, strategically, and relentlessly. When the markets collapse, remember this pattern, because you're watching history repeat itself. The faces change, the industries change, but the game never does.